Hello everyone and welcome to a market update. Today is Tuesday the 27th of August, getting close to springtime. Top three things today are going to be the war on cash, the US dollar, and interest rates. So first of all, the war on cash. I've been talking to a lot of you, my clients, about recent issues in transferring money around. It seems like it's getting harder and harder for you to access and transfer your hard-earned cash between accounts. As many of you know, we do some private investing on your behalf, and oftentimes that means you've got to move significant amounts of money, 25, 50, 100,000 or more at a time. And some of the feedback that I've been getting, which I think is quite interesting, is that the banks are taking a greater interest in asking you what you're doing with your money. Now, I find this to be particularly concerning because, of course, in the first instance, it is your money. And I suppose it's, it's okay, I think, if the bank wants to ask you, are you sure it's not a scam, that sort of thing. But it really shouldn't go much further than that. They shouldn't be able to stop you from making a transaction on your account or put in additional imposts for you to move your money around. And the feedback I'm getting, what I'm observing is that's not the case. It's actually become very difficult in many cases for people to move their money around. And I find this to be very interesting, and I'm wondering whether there's something going on out there. I know it depends on who you talk to and what you read. If you Googled war on cash, you'd probably get a whole bunch of interesting hits. A lot of people think that we're trying to move towards a social credit system and some sort of digital currency. The reality is we're already in a digital currency, and that is the US dollar and Australian dollar and euro and all these things are more or less digitized. Like, very rarely do we use this right here, the cold hard cash, anymore. We don't really transact on that much anymore. Everything is a debit card or a phone tap or whatever, a transfer, an EFT. Transfer. So we're very much digital already in that respect, but of course we have digital currencies which are floating around, and people are talking about that we might be going to some digital currency platform. I can't really see that happening anytime soon on a global scale. So I think we're going to continue with our normal currencies. But it's something that I would ask you to just pay attention to and maybe be a little bit vigilant on, insofar as using cash when you can. So one of the things I've recently done is I've gone to the ATM and I've taken out a whole bunch of that stuff, and I've been paying for my date nights with my wife Michelle when we go out to our local restaurants. They are now many of them are giving a little bit of a discount for cash. I try to pay all of my small businesses that we deal with, like the butcher and the baker in the local area, with cash, because first of all, as you all know, small businesses are the lifeblood of our economy, and many of those small businesses rely on getting cash in because there's no transaction costs with cash. A lot of the times you'll see now where merchants are passing on the fee, whether it be just the direct debit fee of, I think it's usually about 20 cents, all the way up to merchant card fees of 2% or more. They're passing those on to you. That is a cost that is just made up. It's just a figment of the imagination. It doesn't cost any money for these people to actually transact on this. It's just ones and zeros flying around in the ether. But they, as the merchants providing a service, which is the card, take that additional fee. So the moral of this whole story is, please give some consideration. A couple of things to consider in this war on cash. First of all, try to do business with local businesses. If you have a local business that can provide you a service or a good, please do that. Where possible, pay with cash. So go to the ATM and withdraw cash and use it and get back into the habit of using it. One final thing to notice about all this, or have you noticed, they are taking all the ATMs away. Like, all of the many bank branches are closing for starters, but the second thing is that ATMs are also disappearing at a rapid rate. I can imagine closing the bank branches in a lot of areas because that is a huge fixed cost for banks to continue with. But getting rid of the ATMs to me seems a bit odd, and in many cases they're replacing the ATMs with private ATM networks. So I just thought I'd bring that to your attention and have you maybe think about that and see what your experience is as well in relation to transacting with a bank and your daily limits and all these sorts of things. Probably not a bad idea. I've said this before in other updates and things that I've done, and I'll remind you now. It's probably not a bad idea to have a couple of grand of cash floating around the house, maybe in a drawer somewhere, stashed safely at home, just on the off chance that the ATM network goes down or something bad happens where you can't get access to your funds to even transfer it around. And I'm thinking here about the CrowdStrike issue. You may recall in recent memory, I think within the last month, we had that issue with the flights, last couple months, with the flights all being, well, global aviation basically being shut down because of a software update, they said, with this firm called CrowdStrike. Could the same thing happen to the banking sector? Of course it could. So the good thing is that if you have that in your wallet, you will probably be able to buy certain things from the grocery stores and so forth. That's enough about the war on cash. Give me some feedback on that, please. If you have any stories to tell about that, I'd love to hear them. So item number 2 was U.S. dollar. So the U.S. dollar has now begun to really slide, and we're seeing the euro, the Aussie, the yen, other currencies strengthen against the U.S. dollar, and the U.S. dollar index has been falling. What does this mean? Well, it means that the U.S. the traders in the U.S. and globally are beginning to price in or have priced in an interest rate cut. And of course, what that means is that when interest rates are cut, the desire to hold U.S. dollars will be less against other currencies because the interest rate differential will be compressed or lower, and so people might want to own other currencies over and above the U.S. dollar. It's also a little bit of a sign of weakness in the U.S. economy. So we are seeing the U.S. economy at this stage starting to slow. We are going to be entering a monthly, let me see if I have this chart up. I think I do. Yep. Again, just as a reminder, we're going to be entering a monthly quad 4 in the month of September. So we're literally banging on the door here of September, and we're starting to see a little bit of volatilities come out of the market, but some of the economic data that's feeding through right now is not great for the U.S. So it'll be quite interesting to see, as I've talked about before, what's going to happen the rest of this year, because we are bouncing, as you can see here on the monthly quad outlook, sort of between 4 and 2 and 3 and 3 in the next quarter and plus 1 month. So really the modality of the next quarter is for a quad 3, which is inflation elevated and continuing to be high, but growth stalling or even falling. And that's what, I'm not going to review it just now, but that's what the GDP forecast looks like in the US anyway, where GDP is going to continue to slow whilst inflation stays elevated. One of the wild cards with that and the US dollar will of course be oil, and seeing if these current renewed sort of fires burning over in the Middle East, particularly in the Israeli-Palestine conflict, continues to keep the oil price elevated. And of course, in the background to that, we have Iran possibly, who knows, may start some action. I certainly hope that they wouldn't be so stupid to do that, because I think if Iran did anything to attack an ally of the U.S. or outright attack the U.S., it's going to be on like Donkey Kong over there, and it'll be another all-out war that the U.S. will engage in. So that'll cause oil to go to who knows where, which of course would completely stuff inflation and drive it even higher. Let's hope that that doesn't happen. In fact, let's hope that there is some form of resolution coming in that whole conflict over there. It's just not pleasant at all. So in any case, that's where we are with the U.S. dollar. Oh, and the other thing I was going to tell you about the U.S. dollar and point out to you is that correlation table that I haven't shown in a while, but I'm just going to grab it and show you again the USD correlation. So when something's negatively correlated, it means that when it goes up or down, the thing that it's correlated against reacts in a certain way as well. So in this case, the great example here is the S&P 500, gold, and Bitcoin are all negatively correlated to dollar. So as the dollar falls, those things typically are going to rise. Now there's a few other little nuances there that we have to consider, but the correlations are quite strong, suggesting that as the dollar continues to fall, we will continue to see the S&P, gold, and Bitcoin and probably other cryptocurrencies rising. So that's something to take note, especially when you consider 180 days ago or even 120 days ago, these correlation tables were almost completely different. We had a positive correlation across the board, where because the US dollar is quite strong, many of these things were actually falling. So that's something to just remind you of and refresh on. And finally, interest rates. So we have the RBA meeting. They didn't meet this month, and they're not meeting the first Tuesday of September, but they're meeting at the end of September. So remember, they went from I think 11 meetings to, I think they dropped to 10 or 9 meetings a year. So they have a meeting coming up in September. This is the RBA. On the 24th, I think we're going to get an interest rate announcement, and then we also have the U.S. Fed having a meeting in September, a week before that. So on the 18th of September, of September, we're going to get a Fed meeting. Now the Fed has been tipped to that they're going to reduce interest rates. We've already seen the bond market adjusting to that, so we've seen interest rates across the curve falling, which is good for bond prices themselves. So bonds now are rallying or rising across the yield curve, and so interest rates falling is a sign that the Fed will probably go ahead and do their cut. Now there shouldn't be any further reaction necessarily in the interest rate market because they've already been discounting for that or pricing that in. But what will be interesting to see what the Fed actually says about it, whether they say this is it, we're one and done, whether they do a 25 basis point or 50 basis point cut. That will be quite interesting to see. And the follow-on from that will be in the months of October and November and December to see what the inflation data does, because for those of you that have been watching these updates over the last few months, you know that I have been saying to you that inflation, at least in the U.S., will continue to rise or will rise in the back half and back part of this year if interest rates are cut, and that's because inflation has not been tamed, and cutting rates is not going to alleviate the inflation issue. Inflation is a function of having a lot of money supply out there and then the availability of credit as well. So cutting interest rates will drive inflation, will be inflationary, and that's going to create a real issue potentially for the central bank in, say, November and December, where if we see that inflation has risen, they're going to be thinking, well, maybe we need to take that rate cut that we just offered up and did, maybe we have to take that back. Or they might just simply say we're not cutting rates again until we see inflation getting under control. So there's a lot of very interesting dynamics at play here, which again would be one of the reasons why we're seeing if I can find it, we're seeing the monthly quads continuing to be suggestive of inflation and inflationary environment. Now, even 3 or 4 months out, this data can change. I think the monthly quad outlook is pretty good in terms of where the data points are at the moment. But even if we look at December and January, I would say we'll just have to wait until we get another quarterly update. I'll give you another quarterly update on that to see where next year is shaping up. Having said that, though, we are broadly looking at GDP hopefully beginning to bottom and then maybe even reaccelerate into next year. These are the GDP projections where we've got third quarter GDP at about 1.65 in the U.S. and then reaccelerating over the next couple of quarters, bouncing around a little bit. So we'll just have to see what happens. In terms of Australia, I think that we'll just have to see what happens with our inflation metrics. I think I had an inflation. Let me just grab this real quick. I did have the inflation rate up. Remember that the inflation rate in Australia actually went up in the last quarter, which is not good. And we have our next reported inflation in not until October of this year. So one of the big questions, of course, on all of our minds will be, is the RBA thinking about cutting interest rates here? I can't see how they would be, only because inflation has not continued to drop. So I just can't see how they're going to be able to cut rates unless and until we see that inflation figure really start to fall. Having said that, though, there could be some event that occurs that is maybe an emergency response by the RBA where they have to cut interest rates or would cut interest rates in the face of something. But at this stage, I can't see it happening. And I certainly don't see us dropping to a 2.8% inflation rate, which is what whoever is forecasting this has forecast. That's just crazy. You're not going to get a full point of inflation coming out of the economy in one quarter. Now, the good news, though, on the inflation front is the Aussie dollar is strengthening. So the Aussie dollar has gone from around 63, 64. It's shot right up to around 67, between 67 and 67 and a half. So if we see the Aussie dollar continuing to rise, that'll be a good thing for us because, of course, that means that our purchasing power will be improving, which means things like fuel will get cheaper, all of the imported goods and things we import will get a bit cheaper, and that'll be a benefit to us. And in fact, the Aussie dollar now is probably, compared to the US dollar, the Aussie dollar is in a strengthening phase and will continue to rise over the coming quarters, especially if the US dollar does continue to fall and has any sort of continued dramatic fall. We should hopefully see the Aussie. I'd love to see the Aussie get back in the 70-cent range. Wouldn't that be great? It would make all of our holidays a little bit cheaper, and probably some of those imported goods even cheaper as well. And it will help with inflation here in Australia. Obviously, we still have to have the Australian government stop spending money like they have been, promote programs for growth, and certainly to grow the economy in Australia and get labor firing as well. So I think that's really about it. There's not much more to say. There is a lot of actually, no, sorry, I was going to talk about volatility real quick. Let me just grab the volatility table because this is something, or chart rather, this is something that I do talk about quite a bit. So volatility did spike. I think I talked about this vol spike around the time or just shortly after it happened. And we now see that vol has sort of smoothed back out again, but it's still sitting around that 16 vol. Oopsie. What's happened to my chart here? Let me get this chart open. It's still sitting around that 16 vol, which is, for all intents and purposes, it's still elevated, but not in the bucket that's uninvestable. It's in the sort of chop bucket, but getting closer to being more in that investable bucket side. So anyway, that's volatility for you. And I think that's about it. There isn't anything else I really wanted to mention today. So we've probably got another couple of months of interesting market action and positioning to see what really how we get set up, I should say, for 2025. We, of course, have this election coming up. That's going to potentially be a catalyst for volatility. If you remember back in November of 2019, I guess, when Trump was elected the first time, the stock market initially got pounded, and then all of a sudden, within the same day, I think it was in the same day, it reversed course and then was up some ridiculous amount. So I wouldn't expect anything less than some volatility around that event. That's not coming up for a little while longer, though. We still have a couple of months from that. But that's probably one of the big geopolitical events coming up that could impact stock markets outside of what's going on in both the Ukraine and in the Middle East. So with that, I will say have a fantastic rest of the week. Let's cheer on spring. And if anything changes dramatically in the next week or so, I'll certainly leave another market update. And I will also add, if you do have any questions or you need to get in touch with me, please book yourself in. We've now moved over to Teams as our preferred platform to do our video calling. So I've no longer using Zoom. And because we've got a Microsoft Teams running here and Microsoft products running here, so Microsoft Teams is the go. All that happens in the background, though. You'll just get a link to a Teams meeting, and we will meet on that. Okay, great. With that, I will say have a great rest of the week, and all the best. Talk soon. Bye.